You are in the right spot. If you click this video, chances are you are looking to purchase a home and more than likely looking at an FHA loan as one of these options. You don't just accidentally click onto an FHA loan video. So I'm going to keep it clear, keep it concise, and teach you everything you need to know to use an FHA loan. In this video, I'm going to cover what credit score do you need? What's the down payment look like? How do you calculate my income? What properties can I use? Can I purchase multifamily properties? What documents do I need? We're going to cover all of this. But before we do that, what exactly is an FHA loan? For some, it's a first-time homebuyer loan. Is that true? Not necessarily. You can actually, believe it or not, purchase a home using an FHA loan, even if it isn't your first time. An FHA loan is a government-backed loan. It's meant to be a little bit more flexible on credit, on down payment, and for qualifying you on your income. Whether it's your first time purchasing a home or you just need a program that's a little bit more flexible with certain things, FHA could be a great option. So now let's talk about the credit and down payment requirements. So FHA loan, like I said, is very flexible. It starts off at 580 as your minimum credit score if you're going to put 3.5% down. Now, you can purchase a home using an FHA loan with less than a 580. Between 500 to 579, if you put 10% down, then you could potentially qualify for an FHA loan. Most people put 3.5% down on an FHA loan. It's just the way it goes. So usually they're going to have their 3.5% down, but they're also going to need to have closing costs saved up. So think of it like this. You have your down payment, you have your closing costs. That adds up to your cash to close. So cash to close equals down payment and closing costs. As far as closing costs, that could be anywhere from 2 to 5% of the purchase price of the home. Well, what are closing costs? Think of it like this. Your down payment is the money you put into the house, okay? FHA requires you to put 3.5% down. That's going into the house. Nobody else touches that money. Now, you are purchasing a home, so those closing costs are used for other fees in the transaction. Title fees, lender fees, if you're getting any discount points, taxes, insurance as well. These are going to be what are called your closing costs. Little fun fact, a seller or even a gift from a family member can cover these closing costs. So don't be discouraged if you only have your down payment, you don't have your closing costs situated. Those can be negotiated in, or like I said, you can get a gift from family to help cover those. I'm going to take a sidestep here. I did mention that the minimum credit score is a 580 if you want to put 3.5% down. I will mention though, some lenders have overlays. What do I mean by this? So the FHA has their own guidelines, right? Very black and white. They have their rules. Some lenders, they want a little bit less risk. What they'll do is they'll add on overlays. So you have your FHA guidelines. These are their requirements. The overlays will go on top. So some lenders could say, hey, we don't want a 580. We only want 620 plus. So make sure you're working with a lender who's well-versed in FHA, has a little bit of leeway as far as what they can consider usable, approvable. Point being, just make sure they know what they're doing when they talk FHA. Now let's get into the mortgage insurance. A lot of people will think, well, an FHA loan has mortgage insurance. Conventional loans don't have mortgage insurance. Not the case. A conventional loan, if you're going to put minimum down, is also going to have mortgage insurance. So this is why it's very important to compare the two when you are purchasing a home, especially if it is your first time. The only time a conventional loan won't have mortgage insurance is if you put 20% down. An FHA loan will have mortgage insurance, even if you put 20% down in an FHA. There are going to be two parts of your mortgage insurance on an FHA loan. There's going to be your monthly mortgage insurance. This is included in your monthly payment. So your principal, interest, taxes, and insurance, all that's bundled up into one payment. That's what you pay every month. There's also what we call upfront mortgage insurance. This is going to be 1.75% of the loan amount. Now, does this get put in your closing costs? Actually, no, it does not. It gets financed in. So think of your base loan amount. The upfront mortgage insurance is actually going to get stacked on top. You don't need to worry about coming to closing with that money. The reason why FHA requires this is really just because they're so lenient on the down payment itself, also with the qualifying and whatnot. So because of this, they want their own mortgage insurance just to make sure the loan does well, make sure that they're covered in case any mishaps happen. Now let's talk about how much of a home can you afford. When a lender looks at your file, what are they looking at exactly to determine how much of a home you can qualify for? Great question. This is where you're going to hear a term called debt to income ratio. Austin, what is that? Basically, it's your gross monthly income, not your after taxes. This is before taxes. Your gross monthly income is going to get considered. So for easy numbers, let's say you make $10,000 a month. Okay. The debt to income ratio is exactly that. There's your debt to your income. So your income is going to get compared to your debt. Now it can't pass a certain threshold. So there are two thresholds with an FHA loan. There's your front end DTI and your back end DTI. The front end is only going to be your mortgage payment. Your mortgage payment cannot exceed 47%. That's the threshold. The back end ratio is the mortgage payment included with all other debts that you have. Any student loans, car loans, personal loans, credit cards, all of that gets considered in your back end ratio. That cannot exceed 57%. So with the example of $10,000 a month, if that's the case, then your front end ratio, your mortgage payment only can exceed about $3,900 a month. Let's say you have a car payment, some student loans, credit cards. Now look at the minimum payments for all those, add them to the mortgage payment that you're going to be making. And now that we're looking at the back end ratio, if you take 57% of the $8,300 a month that you're making, then you can't exceed $4,750 a month. That's going to be the top. That's going to be where your pre-approval maxes out essentially. Now, let's say you get a pre-approval letter, you want to raise it a little bit. Here's a couple little tips. One, you can lower your interest rate. So you could buy down points. You can negotiate with the seller to help cover some of the closing costs for those points. Points are essentially upfront interest that you pay to lower your interest rate. So think about it like this. If I'm lowering the interest rate, in theory, then that's going to lower the mortgage payment. That's going to lower the debt to income ratio to where now I can qualify for more house. You can also put more money down to lower your debt to income ratio. Again, so you can qualify for more. And another option is really just paying off debt. Again, we only look at minimum payments. So let's say you have a $10,000 loan, but the monthly payments on it's $100 a month. If you have something else that's maybe $5,000 in total balance, but the monthly payment's like $1,000, that's going to be something that you want to target to pay off first just because the minimum payment's higher, right? You're going to get better bang for your buck when it comes to lowering your debt to income ratio. We've talked about some of the financing, but what about the property itself? What do we look for on a property on an FHA loan that's going to work, right? That's going to pass? Does it need to be in livable condition? The answer is yes. The property needs to be safe. It needs to be livable. It needs to be basically move-in ready, if that makes sense. The FHA loan is a primary residence loan, so you can't really use it for investment unless you purchase multifamily, and I'll mention that a little bit more later. Here are some things with the property that an FHA loan is going to look for. They're going to look for functioning plumbing, electricity, heat. They're not going to want any peeling paint, and they don't want any structure, safety, any health issues with the property. If there's black mold, it needs to get fixed. If there's issues with the foundation, it needs to get fixed. If there's a hole in the roof, it needs to get fixed. That property needs to be in living condition. As far as types of properties, you can purchase single family. Obviously, you can purchase multifamily up to 4 units. You can even purchase a condo if you'd like, but the condo needs to be FHA approved. So that's one of the things that you can chat with your lender on. If you find a property, a condo specifically that you're interested in, make sure you run it by your lender. Make sure you run it by them, see if they're on the approved list. That way you can finance at FHA if that's what you want to do. So if you do want to dabble in multifamily with FHA, the cool thing is that you actually can, and you can do it for 3.5% down up to 4 units. Pretty sick. There are a couple catches. The biggest one, you need to live in the property. If you're going to be putting 3.5% down, FHA is going to want you to live in that property as your primary residence, at least one of the units. By doing this, it's a great opportunity to do what people call house hacking. So the idea is you live in one of the units and then you rent out either the second, the third, the fourth unit to cash flow and eventually kind of pay for itself. That's the idea with house hacking. For 1 to 2 unit properties, it's pretty simple. You just need your 3.5% down, and then obviously you need to qualify for the property. Make sure you're hitting the debt to income ratio limits. When it comes to 3 to 4 units is when things get a little bit different. Once you get to 3 to 4 units, the property needs to pass a self-sufficiency test. What does this mean? The simplest way I can explain this is that 75% of the rental income needs to cover the entire mortgage. How do we get the rental income? When the appraiser goes out, if it's a 3 to 4 unit, they're also going to have a 1004R. This is going to analyze the properties nearby, get some comps of rentals, and they're going to use that number, again, 75% of what the rent is, and make sure that that covers your entire mortgage payment. If the property doesn't pass that self-sufficiency test, then it's kind of a no-go, right? If it's that 3 to 4 unit, doesn't pass the self-sufficiency test, then you're going to either need to put more money down, get the interest rate down, or find another property that is going to rent. Again, 75% of the rental income needs to cover the entire mortgage. Very, very important when it comes to 3 to 4 units. Very important. Let's throw a little example in here. Let's say, for example, you're doing a 3 unit, right? Each one's going to be $1,000 a month, okay? 75% of that is going to be $2,250. That's the number that you can't exceed for your mortgage payment. So think of it like that. If you have an idea of what you want to charge per door, times it by 75, that is what your mortgage payment cannot exceed. Lastly, let's touch on the documents that you're going to need to submit to your lender to get considered to get pre-approved to purchase the home. If you're somebody who's W-2, usually going to be hourly or salaried, you're going to need 2 years copies of your W-2s, 30 days worth of pay stubs, 2 months worth of bank statements. If you're somebody who's self-employed, it is a little bit different. You're going to need to show 2 years of your tax returns, in some cases a profit and loss statement, and also business bank accounts. Or if you use a personal account, copies of the personal account, that needs to show business funds moving around. And also, obviously, your down payment and closing costs as well. That is the FHA loan in a nutshell. If you like it, make sure you like the video. If you hate it, make sure you hate the video. Leave a comment below for any takeaways you had, any questions you have. If you're somebody who's serious about purchasing a home, make sure to click the link in the description.